Welcome to the Deep Dive. It's Wednesday, December 10th, 2025, and the official market sentiment is, well, neutral.
Which usually means stability, maybe a bit boring.
Exactly. Low drama. But we know institutional desks are looking right past that headline column.
Absolutely.
So our mission today is to really analyze the stack of material you sent, over-focusing on liquidity, on volatility structures, and those critical correlation breakdowns.
Right.
We want to find out what high-conviction strategies are being deployed beneath this illusion of neutrality.
That phrase really is the core of the strategy right now. I mean, when the easy money's been made, the institutional focus, it shifts entirely. It moves to structural fragility.
So you're not just looking at the closing price of the S&P.
No, not at all. We're digging into the sophisticated language of futures volume, options term structure, cross-asset analysis.
To find the subtle shifts.
The shifts that could lead to, well, asymmetric downside risk. We're looking for the ticking clock that the VIX just isn't showing us.
That sounds like a much more intense morning brief than the headlines suggest.
It has to be. Because structural risks, they build quietly, but they manifest violently.
Okay, let's start on that tactical level then. Let's zoom into the pre-market view for the futures. The ES, NQ, and RTY.
S&P, NASDAQ, and the Russell.
The immediate goal, you said, is to spot the trapped traders. So how do institutions use those key overnight levels to define that vulnerability?
It all revolves around conviction. We basically define the arena using key overnight levels.
The ONH, ONL.
Exactly. The overnight high, the overnight low, and crucially, the point of control, or POC.
Yeah.
A trapped trader is just someone who chased a false breakout.
They got in late.
They got in late. So if the market pushes above the ONH, late buyers jump in thinking it's momentum. But if that price immediately reverses, snaps back below that high on heavy volume.
They're underwater.
Instantly. There are trapped longs.
So the key isn't the high itself, it's the failure to hold that high. Can you give us a specific example of how that hunting mechanism works?
Sure, let's use the ES. Let's say ES pushes above its overnight high, call it 50-20.
Okay.
But then within minutes, it rapidly reverses back below 50-20 on significant selling volume.
Right.
The institutions, they know exactly where to apply pressure now. Those buyers who bought at 50-21, 50-22, their stop losses are all clustered just below 50-20.
So those stops become the fuel.
They are the immediate target, the fuel exactly if the market decides to press lower after the open.
It sounds like this really sophisticated game of managing market depth. And this often involves what you call liquidity grabs, right? Where institutions intentionally probe a level.
Absolutely. A liquidity grab is when a large player tests the market's depth without really committing to a full move.
How does that look on the tape?
So imagine ES quickly dips to the ONL, say 5,000. It's a rapid high-volume probe.
Okay.
But if the market immediately reverses and the bounce back up is on low volume, that's the tell.
What does that signal?
It signals the level was just tested for depth. The institution wasn't really selling. They were just checking to see how many bids were sitting there at 5,000, maybe accumulating a position, before quickly lifting the market again. It's accumulation, not distribution.
And we also have to look for divergence. The sources really highlight that the NQ, tech often leads the ES and RTY.
Always.
So if NQ is aggressively pushing new overnight highs, say it's above 18,000, while the ES and RTY are lagging, what does that divergence truly signal?
It signals fragile, narrow strength. It's a concentrated bet, usually in just a handful of massive tech stocks, that isn't backed up by broader market participation.
So if that tech leadership fails,
if that NQ conviction fails to drag the rest of the market along with it, it's a massive red flag. Narrow strength can be reversed violently, and that fragility, well, that connects us directly to the structural health of the entire system.
Okay, so that's the tactical intraday picture. Let's pull back from that specific action to the structural health of the market. Let's talk volatility and liquidity. The spot VIX is sitting calm, 15.41. It's the surface of the pond, but we need to look underneath, right?
Right. The headline VIX is, well, it's highly deceptive. The institutional focus is entirely on the VIX futures term structure.
So the curve.
The curve.
Yeah.
The typical healthy state is what we call contango. That's where futures dated further out are more expensive than the near-term ones. It just reflects normal complacency.
Okay, so if that curve starts to flatten, or even worse, it flips, what does that imply? For someone who doesn't track VIX futures daily, what does backwardation actually feel like?
Backwardation. That's where the front month VIX futures trade higher than the back months. It's the financial equivalent of a sudden high-grade fever.
A panic button.
It's a panic button. It means immediate protection is suddenly far more valuable than future protection. It signals acute, near-term anxiety and a scramble for hedges. Even a subtle flattening right now tells us the market is quietly building up unpriced short-term stress.
And that stress is compounded by this thinning ice of year-end liquidity issue. We know volumes naturally drop, but the source material you sent cited hard evidence of a deeper structural strain.
Yes, the underlying plumbing is stressed. We saw data showing the average daily cost to trade U.S. equities has increased by, approximately 36% in 2025?
36%.
That jump isn't noise. It's a measurable widening of bid-offer spreads across the board.
A 36% increase in trading cost? That implies a severe reduction in market depth. It means there's less institutional buffer, fewer buyers and sellers to absorb any shocks.
Precisely. And when liquidity is this thin, institutions know that even a minor selling event, a small policy surprise, can trigger these outsized, amplified price movements.
So it turns a small wave into a potential rogue wave.
Exactly. Just because the market lacks the depth to absorb the volume.
Okay, so now that we've established that internal fragility, let's connect it to the cross-asset landscape. Because if sentiment were truly neutral, things should be moving more or less in unison. But the sources show extreme divergence in late 2025.
Oh, it's not a uniform risk-on market at all.
Not even close.
The divergence is, it's fascinatingly complex. On one hand, you have the S&P 500 resilient, up nearly 18% year-to-date. It's a classic risk-on.
Right.
But then you look at gold, the traditional safe haven, which is surging over 60% year-to-date, trading around $4,200.
So the market is simultaneously pricing in euphoria and existential fear.
That's a perfect way to put it.
And that massive flight to safety in gold is being fueled heavily by the weakness in the US dollar. The DXY is down over 7% in the last year.
Correct. And that weakness is a direct function of the Fed's pivot towards easing, rate cuts.
Yeah.
It reduces the yield advantage of holding dollar assets.
Yeah.
But structurally,
Dip deficit.
it's the projected $1.7 trillion deficit. Yeah. The market is signaling real concern over the sheer volume of U.S. debt needed to fund everything, and that's eroding the dollar's long-term value.
Which boosts hard assets like gold. And this leads us to the biggest structural oddity of all, the U.S. 10-year Treasury yield. The Fed is cutting rates, yet the 10-year yield is rising. It's at 4.19%. That should not be happening.
This is the unusual disconnect. The bond market is effectively shouting that it needs higher compensation because of two huge risks.
Okay, what are they?
First, the fear that inflation will be stickier than the Fed thinks. And second, the overwhelming supply of U.S. debt from those deficits. That bond market is demanding a higher risk premium, which fundamentally challenges the idea that bonds are a guaranteed safe haven.
And finally, in this mix, we have Bitcoin, historically viewed as this potential digital safe haven. What's its actual behavior right now?
Bitcoin, which is trading north of $90,000, is behaving exactly like a high beta equity proxy.
So like a tech stock on steroids?
Pretty much. Its 30 to 60-day correlation with the S&P 500 has surged to a decade high of 0.72.
Yeah.
It's fully integrated into the speculative risk spectrum.
And its correlation with gold?
Starkly negative. It's approaching minus 0.5.
Yeah.
And this is the critical institutional takeaway. Bitcoin is not currently functioning as a true digital safe haven. It's a risk asset. Relying on it for diversification in a systemic shock is highly risky.
So this extremely divergent landscape, it all converges on today.
Correct.
The Fed's final FOMC meeting.
Yes.
The rate cut itself might be priced in, but the real action is in the dot plot and the chair's press conference. That's where the market is most likely wrong.
The market is implicitly pricing in a much more aggressive path of rate cuts for 2026 than the Fed has ever signaled.
So they've gotten ahead of themselves.
Way ahead. If the new dot plot confirms a much slower pace, say, it projects only 1 or 2 cuts when the market expects 4, it's a huge reality check for this risk rally. The Fed needs to reset those expectations.
And there's this subtle but profound structural idea that the market is underestimating the neutral rate, R-star. Why might things like deglobalization and fiscal spending have pushed that baseline rate permanently higher?
R-star is that theoretical rate where the economy is in perfect balance. But if structural factors like reshoring supply chains, which is just inherently more expensive, and the constant need for massive deficit spending, if those create persistent inflation,
the Fed's job gets much harder.
Much harder. It means the new neutral rate is higher, maybe 3.5% or 4%. And if that's true, the current 5% rate isn't nearly as restrictive as investors believe it is,
Meaning the Fed has to keep rates higher for longer.
for much longer, to achieve their goals.
And that leads us right to the definition of the pain trade. Given this neutral, soft landing outlook that seems priced in, what's the scenario that inflicts maximum pain on the consensus?
The pain trade is a resurgence of sticky inflation,
Mhm.
one that leads the Fed to maintain its restrictive stance longer than anyone anticipates, or even worse, signals a potential hike in early 2026.
Oof.
That scenario crushes anyone positioned in long-duration assets, high-growth stocks, long-term bonds, because higher rates for longer just brutally discount the present value of future earnings. It shatters their valuation premise.
So let's synthesize this. What does this all mean for the institutional trading thesis, for this illusion of neutrality?
The thesis is that the current calm is purely superficial. It's masking this deep-seated asymmetric downside risk.
Created by two core vulnerabilities.
Right. First, what we're calling complacent illiquidity. Year-end thinning, combined with those structural changes, has just reduced true market depth. So any unexpected selling will be amplified.
And the second structural vulnerability, the one that terrifies anyone relying on traditional portfolio theory.
Stealth correlation convergence. Diversification is failing. The data shows that even sophisticated strategies like event-driven or relative value hedge funds are showing unexpectedly high correlations to the S&P 500.
So when the market finally moves lower,
Everything will fall together, which erodes diversification precisely when you need it the most.
that is a very high conviction downside thesis. So to confirm it, what are the three critical pivot levels or signs that would tell us this risk has fully materialized?
First, a sustained, significant, and really dramatic widening of bid-ask spreads across all major asset classes. Not just stocks, but credit too. That confirms dealer capacity is exhausted.
And the second, something we touched on earlier.
A complete and sustained inversion of the VIX futures curve. Full backwardation that lasts for more than, say, 3 to 5 consecutive days, that signals full-blown panic.
And the third indicator, the one that confirms the failure of that crucial bond-equity relationship.
It's the ultimate failure of the safe haven trade. You'd need to see simultaneous sharp declines in global equity indices, a drop of more than 3% intraday, let's say,
Okay.
without a corresponding flight to quality bid in long-duration U.S. Treasuries.
Okay.
If stocks and bonds both sell off hard, at the same time, the entire structure of the modern portfolio is challenged.
That makes tactical precision and rigorous intermarket analysis absolutely paramount right now. You can't just rely on historical norms when the structures themselves have changed this fundamentally.
Absolutely not. The market is demanding a much higher level of vigilance than the VIX currently implies.
Which leaves us with this final provocative thought for you. If that traditional negative correlation between stocks and bonds is unstable, and if Bitcoin isn't functioning as a true digital safe haven, where do you look for a reliable, truly uncorrelated diversification when the market finally experiences a systemic shock? Something to mull over. Thank you for joining us for the deep dive.